Thank you for joining me in this second video in our life insurance series. Now, if you haven't had an opportunity to watch the first video, I would encourage you to go back and watch that before you watch this one. Also, quick reminder, Financial Design Studio, we don't sell any insurance for clients. That said, we do review insurance as a critical aspect of each client's financial plan. This video is all about what goes in and what comes out as it associates with the life insurance policy. Did you know that with your life insurance policy, your premium isn't exactly your cost? It's crazy, right? It doesn't seem to add up. Well, as we went through before in our prior video, with the term contract, you're fine, you're good. Your cost is exactly what your premium is, apart from maybe you have some rider costs on top of it as well. But suffice it to say, all the money that you put in, you're not using it for a savings account. With the permanent policy, however, we do have that option. So it's important to be mindful of premiums versus costs. We're gonna get into some of those specifics here in just a minute, but for now, I wanted to go through how we can evaluate maybe a term contract and see the costs of that underneath and what is actually a good policy versus maybe a not so great one. I always find examples really helpful when I'm trying to understand something. So for today, let's actually use the example of John. John went out and got some quotes from two different insurance companies. Let's say company B and company C. For company B, we requested a quote and we got an offer of $750,000 for a cost of $875 a year. Okay, great, but is that a good price? We don't know. We need to compare it with something. Company C is offering a policy at $950,000 for a cost of $1,300 a year. Okay, great. We had 4 of those data points and now we need to figure out which policy is the better one. In this case, we're going to use a calculation called the cost per thousand, which is simply the total cost, in this case, either $875 or $1,300 over the number of thousands for each of the policies. So in this case, with insurance company B, we take 875 divided by 750, we're left with 1.25. We do the same calculation for company C, we take $1,300 over 950, and we get 1.37. So in this case, we have our final resulting numbers. Well, which one's better? If you step back and think about this, we want to pay less, get the same amount from either side. So in this case, since we're paying a less cost per thousand with company B, that's the carrier that we would want to go with. Now, what if John needed additional coverage? They only offered $750. The way that we handle that is we would go back to the insurance company and say, hey, thank you for your offer, but can we increase that base amount from $750 up to $950? In that situation, as long as they maintain a similar cost per thousand or even lower, we're in good shape because that's still a better offer than company C. So as you're going through the review of different policies, keep this calculation handy. It's a way to quickly determine, is this a really good offer? Maybe this is not so great. Do it a quick calculation, but also review it in more depth along with all the other variables that are being presented to you. Now let's switch over to permanent policies. I talked a little bit before how part of your premium goes towards the policy costs and part of it goes to the cash value. That means this calculation gets a little bit murkier, a little bit more challenging to do, but we can still get close. Here's how we're gonna do that. We're gonna take our most recent 2 annual statements for the policy, and we're gonna look at how much we paid in premium over a full insurance policy year. We're gonna take out how much the cash value increased and any dividends, and we're gonna hone in on what was the actual policy costs. Now we can actually determine what were those policy costs and divide that by the face amount of the contract. Now, even still, this is not an exact calculation, as we'll get into with some later videos as well. So far, we talked a lot about what goes into a contract, but not so much what comes out. Well, I think it's also important to know if we're gonna be using, especially a permanent contract, how can we get money out of it, assuming we're building up to that cash value? Now, if you have a term contract, you're evaluating the term contract, you're good again, because the only way to get money out of a term contract is unfortunately to pass away. There's no cash value to draw from during that meantime. With a permanent contract, it does get a little bit more challenging. That said, we have some options available to us. With the cash value, we have 2 primary options. Those are going to be policy withdrawals or policy loans. Let's take a look at withdrawals. So let's say we've had a contract for 10 years and we've been paying $3,500 a year into that contract. Our basis in that contract is $35,000 a year. Now let's say the cash value is $50,000. If we want to take out all $50,000, When you withdraw from your policy's cash value, essentially what you're saying is you're requesting the money back out of the contract. Now, assuming that we're taking less out of the contract than what we put in, we're fine. There are no taxes due. We get all that money back to us, apart from maybe some admin charges during the transaction. Now, if our cash value has grown beyond what we paid in terms of premiums, there may be some taxes due. We need to be mindful of that before we decide to execute that withdrawal and basically ensure that we know what our tax picture is going to look like that year. Now with a loan option, things are a little bit different, but not so much so. So with loans, you can actually take up to 90% of your policy cash value out as a loan, assuming your contract offers it. Most do. The trouble here is, let's say we run into a situation where your policy may lapse or you get the policy surrendered. With your policy loan, you can take out up to 90% of the policy's cash value and you don't have to worry about the taxes. However, if you run into a situation where you either surrender the contract or it lapses because it doesn't have enough in the cash value to pay the cost of insurance, if there's a gain between what you put in and what that cash value that you took out as a loan was, that amount would become taxable to you, similar to as if it was going to be a withdrawal. Just something to keep in mind and be aware of before you actually execute any of these transactions. Ultimately, the decision on the best course of action for you really comes down to what contracts you have available, what the provisions are, and most importantly, what your entire financial picture really looks like. We're going to be talking a little bit more in depth about the details associated with face amounts and some of the other things to be looking out for with your contract. So please stay tuned for the next 2 videos in this series. I do hope you found this enjoyable. If you have a contract that you'd like to review or you have additional questions on, please let us know and reach out. We would absolutely love to help.